The Founder Collective Paradox: How a $1 billion track record nearly became irrelevant. $24 billion companies. That's how many startups Founder Collective seeded that crossed the unicorn threshold by 2025. But here's the thing nobody talks about. In June 2025, Eric Paley, one of the two founders who built this VC powerhouse from scratch, walked away from the firm entirely. He accepted an appointment as Massachusetts Secretary of Economic Development and left Founder Collective in September. This isn't a bankruptcy story. This isn't a scandal. This is the story of how a firm with near-perfect investment instincts became so successful that it essentially destroyed the conditions that made it successful in the first place. David Frankel and Eric Paley started with a simple thesis in 2009. Both had been founders before they became investors. Frankel had built Internet Solutions, which became Africa's largest ISP. Paley and Micah Rosenbloom had founded Brontes Technologies, a dental imaging startup acquired by 3M for $95 million in 2006. When Frankel became the first investor in Brontes, he didn't just write a check, he helped them build the company. That experience became the founding principle of Founder Collective, founders advising founders. They launched with $40 million in committed capital in 2009. The fund was intentionally small. Small meant they could own meaningful stakes without massive dilution. Small meant they could support exits of any size, from $100 million acquisitions to $10 billion IPOs. They invested sector agnostic. Their first bets were Uber, PillPack, and SeatGeek. By 2012, Founder Collective had raised a second fund of $70 million and appeared on the institutional investor list of top super angels. In 2016, their third fund closed at $75 million. The track record was building. Cruise Automation, acquired by General Motors for $1 billion. Airtable, a multi-billion-dollar valuation. Kuong, South Korean e-commerce that debuted at $84 billion on the NYSE in 2021. The Trade Desk. Shield AI. By the mid-2010s, Paley and Frankel were appearing on the Forbes Midas list. Esquire called them a Midas touch firm. Then the fourth fund in 2021, $85 million. Then the fifth in 2023, $95 million. Their largest fund ever. The mechanics of their success never changed. Founder partners who still ran their own companies. Early stage capital. Founder first alignment. But something shifted. Here's what the numbers actually reveal. Founder Collective succeeded by being small. Their edge wasn't genius, it was constraint. A $40 million fund in 2009 meant they had to know their founders personally. They had to spend time. They had to care about the outcome, not just the exit multiple. Small funds meant they made fewer bets. Fewer bets meant each one mattered. Each one required deep conviction. But success destroys that condition. By 2023, when they raised $95 million, their largest fund, they had become too big to operate on the principles that made them successful. You cannot maintain the same hands-on founder relationships across 5 times the capital. You cannot evaluate a startup with the same intensity when you're managing more money than you've ever managed before. The founder partners model, still working a startup while VC&G, becomes physically impossible past a certain scale. Paley's departure in 2025 isn't a failure story. It's the logical endpoint. He didn't get pushed out. He took a government position. But the timing reveals the tension. As Founder Collective became the most successful seed fund in America, the conditions that made it successful became harder to maintain. Amanda Herson joined as managing partner in 2023, the same year they raised their record fund. The leadership structure was changing. The fund was scaling. The thesis that built 24 unicorns was being tested by its own success. The lesson isn't about Founder Collective specifically. It's this: the strategies that create outsized returns are often incompatible with the size of success those returns generate. Small, founder-led, Constraint-driven investing beat the market. But the moment you have enough capital to scale that approach, you've already lost the thing that made it work. Paley didn't fail. He recognized the paradox and stepped aside. That's the real decision, not whether to keep growing, but whether to admit when growth means becoming something different. That distinction separates people who understand compounding from people who just chase it.